So let's have a look at this Forbes article with the prediction from Citibank about a rise in silver. Silver has been a graveyard for investors since the Hunt brothers tried to corner the market for a poor man's gold 40 years ago. So when a big name investment bank earlier this week forecast a 60% rise in the silver price, most investors yawned. Citi, which has a well-connected resources research team, has put its neck on the silver block in an advisory note with a tip that the price of the metal will rise to $40 an ounce in the next 12 months. Silver is currently trading around $24.80 an ounce on the London bullion market, having already risen by 38% from $18 an ounce since the start of the year. Citi's case for silver is based on growing demand from investors who see silver as a cheap entry point into the world's precious metals dominated by gold, with a bonus of strong industrial demand. But the bank doesn't stop at a 605% silver rally. It also argues that there is a technical case for silver doubling $50 an ounce and potentially rising fourfold to $100 an ounce. Investors with memories that go back to 1980 will be wary of such optimistic forecasts because of the mess of the silver market by three Texan oilmen, Nelson Bunker Hunt, Lamar Hunt, and William Herbert Hunt, who concocted a scheme to corner the silver market, which they almost did. Unfortunately for the Hunt family and its bankers, the scheme unraveled spectacularly when commodity exchanges tightened their rules on the use of debt to fund trades, causing the silver price to fall 50% in 4 days, triggering panic on other markets. And there's a picture of the Hunt brothers there, getting into a bit of trouble. So when silver returns as a hot tip, there are some market observers who wonder whether there is a risk of history repeating. Citi is confident that's not the case, describing the outlook for silver as a mini rerun of the 2009 to 2011 bull market, a time when silver rose from $11 to $48 an ounce before retreating. Silver is highly leveraged to a global economic recovery with relatively limited downside, Citi said, before adding that it's not for the faint-hearted. The bank said its forecast of a rise to $40 an ounce over the next 12 months is based on a combination of sustained strength in investor demand and a recovery in industrial consumption during 2021. We expect that investor demand for precious metals exposure will remain high during 2021 as pressure on governments to devalue currencies, concerns about vaccine efficacy and take-up rates, and questions over equity and bond valuations and rising global debt remain in most scenarios, Citi said. The bank said its foreign exchange technical team is very bullish on silver, with $50 an ounce a very realistic target and $100 an ounce possible. If Citi's bull case for silver doesn't work out, the bear case, including weak global growth, is not particularly punishing, with the silver price retreating to around $20 an ounce. And there's a picture you can see of the photovoltaics and agriculture, all those solar panels there. So the banks said silver was more leveraged than gold to a sharp increase in inflation, rebounding manufacturing activity, and should benefit more than gold to positive COVID-19 vaccine developments. Well over 50% of silver consumption is tied to industrial demand versus around 10% of gold fabrication demand outside jewelry. More broadly, around 80% of silver consumption looks to be gross domestic product sensitive. Citi also sees the possible election of Joe Biden as US president would be more bullish for silver than gold because of an expected increase in infrastructure spending in areas such as photovoltaics or solar power, and a reduced foreign policy risk premium. So there you go. There's Citi's expectation that silver is headed to $40 an ounce in the next 12 months, probably 50 being a realistic target, and 100 being possible. If you listen to try and think of his name, there's a few silver guys out there who are in the silver market, and they're calling for $100 silver. So what about gold, and why gold? Let's have a look at Jim Rickards. So why gold? Well, that's a question I'm asked frequently. It's usually followed by a comment along the lines of, I don't get it, it's just a shiny rock. People dig it out of the ground and then put it back in the ground. What's the point? I usually begin my reply by saying it's not a rock, it's a metal, and then go from there. I have a lot of sympathy in those conversations. The fact that people don't know much about gold today is not exactly their fault. The economics establishment, policymakers, academics, and central bankers have closed ranks around the idea that gold is a taboo subject. You can teach it in mining colleges, but don't dare teach it in economic departments. If you have a kind word for gold in a monetary context, you're immediately labelled a gold nut, gold bug, Neanderthal, or something worse. You're excluded from the conversation. Case closed. It wasn't always this way. I was a graduate student in international economics in 73-74. Many observers believe that the gold standard ended on August 15, 1971, when President Nixon suspended the redemption of dollars by gold by foreign trading partners. That's not exactly what happened. Nixon's announcement was a big deal, but he intended the suspension to be temporary, and he said so in the announcement. The idea was to call a kind of timeout on redemptions, hold a new international monetary conference similar to Bretton Woods in 1944, devalue the dollar against gold and other currencies such as the German Deutschmark and Japanese yen, and then return to the gold standard at the new exchange rates. Now, I was able to confirm this plan with two of Nixon's advisors who were with him at Camp David in 1971 when he made the announcement. I spoke to Kenneth Dam, an executive branch lawyer, and the late Paul Volcker, at the time the Deputy Secretary of the Treasury. They both confirmed that the suspension of gold redemptions was meant to be temporary, and the goal was to return to gold at new prices. Some of what Nixon wanted did happen, and some did not. The international conference took place in Washington, D.C. in December 71 and resulted in the Smithsonian Agreement. The dollar was devalued from $35 an ounce to $38 an ounce. It was later devalued again to $42.22 per ounce. And the dollar was devalued against the major currencies of Germany, Japan, the UK, France and Italy. Yet the return to a true gold standard never happened. This was a chaotic time in the history of international monetary policy. Germany and Japan moved to floating exchange rates under the misguided influence of Milton Friedman, who did not really understand the role of currencies in international trade and direct foreign investment. France dug in her heels and insisted on a return to a true gold standard. Also, Nixon got caught up in his 72 re-election campaign, to be followed closely by the Watergate scandal. So he lost focus on gold. In the end, the devaluation was on the books, but official gold convertibility never returned. All of this monetary wrangling took a few years to play out. It was not until 1974 that the IMF officially declared that gold was not a monetary asset, although the IMF carried thousands of gold on its books in the 1970s and still has 2,814 tonnes of gold, the third largest holding in the world after the US and Germany. The result was that my class of 74 was the last class to be taught gold as a monetary asset. If you took economics after that, gold has been consigned to the history books. No one taught it and no one learnt it. Gold was still a commodity and something that was taught in mining colleges but not in economics. No wonder most people today don't understand gold. Maybe gold was banned from the classroom, but it was not banned from the real world. In fact, there was another major development just 1 year later, after I graduated. In 1974, President Ford signed a law that reversed President Franklin Roosevelt's notorious Executive Order 6102. FDR made ownership of gold bullion by American citizens illegal in 1933. Gold was contraband, like heroin or machine guns. President Ford legalized it again. For the first time in over 40 years, it was once again legal for Americans to own gold coins and bars. The official gold standard was dead, but a new private gold standard had just begun. That's when things got interesting. Now that gold traded freely, we saw the beginning of bull and bear markets, something that doesn't happen on a gold standard where the price is fixed. The two great bull markets were 71 to 80, up 2,200%, and 99 to 2011, up 760%. In between these bull markets, there were two bear markets, 81 to 98 and 2011 to 15. But the long-term trend is undeniable. Since 1971, gold is up 5,000%, even after the bear market setbacks. Now the third great bull market is underway. It began on December 16, 2015, when gold bottomed at $1,050 per ounce at the end of the 2011-15 bear market. Since then, gold has nearly doubled. That's a nice gain, but it's small change compared to 2,200 and 760% gains in the last two bull markets. When it comes to capital and commodity markets, nothing moves in a straight line, especially gold. But this pattern suggests the biggest gains in gold price are yet to come. And right now, my models are telling me that gold is poised for historic gains as the third great bull market gains steam. Right now, gold's trading at over $1,900 an ounce. What could push it firmly over $3,000 per ounce in the short run and $10,000 to $14,000 in the long run? There are three main drivers. The first is a loss of confidence in the US dollar in response to massive currency printing to bail out investors in the pandemic. If central banks have to use gold as a reference point to restore confidence, the price will have to be $10,000 an ounce or higher. Any lower price would force central banks to reduce their currency supplies to maintain parity, which would be highly deflationary. The second driver is a simple continuation of the bull market, using the prior two bull markets as a reference points. A simple average of those gains during those durations would put gold at $14,000 an ounce or higher by 2026, as I mentioned earlier. The third driver is panic buying in response to a new disaster. This could take the form of a second wave of infections from the cerveza sickness, a failure of a gold ETF, or the COMEX exchange to honour physical delivery requirements, or post-election chaos. The gold market is not really priced for any of these outcomes right now. It won't take all three events to drive gold higher. Any one would do just fine, but none of the three can be ruled out. These events and others would push gold well past $3,000 an ounce, on its way to $4,000 an ounce, and ultimately much higher along the lines described above. So Jim Rickards. Jim Rickards, a little bit about Jim. I've got all of his books, read them all. He's an American lawyer, economist, investment banker with over 35 years experience working in capital markets on Wall Street. He was the principal negotiator of the rescue of long-term capital management in the late 1990s. So, you know, this guy, he knows what he's talking about. He's written many books, got a lot of experience, and that's what he has to say. Now, billionaire Jim Rogers has recently been quoted as saying that gold is going to the moon. However, nothing goes up in a straight line, as Jim put here in this article. He said that nothing goes up without a 50% pullback. But Jim Rogers is saying gold is going to the moon. I would say some other factors that are bullish for the metals is obviously supply and demand, obviously, and we'll have a little look at that in a second, especially on the silver side of things. But also with zero interest rates. So Warren Buffett's one argument was, why would you buy gold? It pays no dividend. It doesn't earn you anything. You could stick your money in the bank and get interest. You know, you could buy bonds and get a return. Well, when interest rates are zero, when you get no returns, in fact, when you've got inflation above the interest, you've got negative interest rates, negative real rates, sorry, and that's bullish for gold. And central banks are saying they're keeping rates low for at least the next 3 years. They're putting them on hold for the next 3 years. So that is a massive tailwind for gold. Obviously, the uncertainty, the debt levels. You know, we keep, and we'll have a look at this shortly as well. The debt levels that the world is putting itself in. People are losing confidence in currencies because of the debt levels, and you know, so it's not inflation, deflation, prices increasing, prices decreasing. It's a whole different ball game as to why I like this. Now let's have a look at this. So this is comparing the world's money and markets. All right, so this is a visualization. So this is the size of the silver market. One little dot there. One little dot. It's a little bit more. It's more than $17.20 an ounce now. But there's the Bitcoin, you know, cryptocurrencies, military spending. This is just a visual size of these markets. Okay, coins, Fed balance sheet, billionaires. There's gold. So gold's a little bit more. Fortune 500. You can see the size of all the stock markets. The currency supply, I hate using that word, money supply. Global debt, you can see here global debt, 322% of global GDP. Yeah, unless you believe in infinity. Global real estate, global wealth. So have a look at the size of these markets and the derivatives market. This thing just goes on and on and on and on. Look at the size of this. It's actually about 1.5 quadrillion now. Look at it, keeps going on and on and on, and we finally get to the bottom. And by the way, this market here, the derivatives market, you should really have a look at what is happening in the LIBOR market, sorry, and the change over from LIBOR to the new system. There's a lot of risk in play there. A lot of risk in the debt market. So the bond market is a hyper bubble, much bigger bubble than anything else. And as we come back up, there's gold once again. And what's the tiny little market? Oh, look at silver. Little there. Tiny little market. Now, we can have a look at basically the amount of currency. This is going back last year, so this isn't even taking it to account now. This is just, as central banks do what they do, this is just currency increase from 2019. So for every ounce of silver, every ounce of gold, this is how much currency they have printed versus the amount of gold and silver that's been produced. So I think that visually says it right there. And here's another look at it. So this is through to September 2020 actually. So the supply, the 2,100 times higher than gold and silver. And everyone wants to hold on to their notes. Good luck with that one, guys. Now, you read Jim Rickards' book and he talks about how to go back to a gold standard. People say you can't do it. Well, that's rubbish. One of the key things is you need to look at the number of dollars outstanding, or the supply of that versus the supply of gold and silver. Now, let me tell you something about silver. Silver's supply peaked in 2016, and guess what? It goes down forever from here. Keith Neumeyer, who owns some of the big silver mines throughout the world and gold mines, says that historically you used to mine for every 1 ounce of gold you'd get about 15-16 ounces of silver. Now that's 1 to 8. So for every ounce of gold, there's now only 8 ounces of silver that they're mining. So and the demand for silver is now outstripping supply. So last year there was more silver demand than there was actual silver production. So the whole supply and demand side of things looks very nice for silver, but it looks nice for gold. And if we look at whether we can go back to some sort of gold standard or something, what we really need to have a look at is the US debt clock. Have a look at the dollar to silver ratio, which is now $4,231 an ounce. This is just a year-over-year increase in US M2 currency supply divided by the yearly world production of silver in ounces. And the gold, or dollar to gold ratio, $32,218 an ounce. Now, I think before the Cerveza sickness earlier this year, I think this ratio was about $900 per ounce. And I'm pretty sure the dollar to gold ratio from memory was around $9,000 an ounce. So countries around the world just continue to devalue their currency, continue to create more and more of it, while there's less gold and silver supply, in particular silver. And we know the demand for silver on the industrial side, and also the whole new push for green energy So I see these as all tailwinds for gold and silver, in particular silver. The whole supply side of it, low interest rates, negative real rates, uncertainty. Just it's never been a better time for me to get into this, and I've seen this since kind of last year. I started buying gold and silver last year. During March, when the market downturn happened, I really loaded up, in particular on silver, and then of course I've been buying a lot of silver and gold miners and junior miners and explorers, and obviously my returns have been spectacular, absolutely spectacular. Now, I'm not telling everyone to go and buy gold and silver. This is not financial advice, and please do not take it as financial advice. This is just me reading a bunch of articles and giving you my opinion and what I've been doing. So don't take this as advice, because at some point I may change my mind on these markets and I might start selling. However, I've spoken before about what's it called? Not the Big Mac index, wealth cycles. That's it, wealth cycles. And I measure gold and silver in other assets. So, 1 ounce of gold buys me how many, pieces of the market, or how many ounces of, or 1 ounce of gold, or how many ounces of gold buys me the average median house. Things like that. I measure gold and silver versus other assets. And so when those things change, I'll be moving out of the gold and silver space and I'll be moving into other assets. It worked for me during the GFC and after the GFC. Silver was really good for me in that 2009 to 2011 period. I was able to turn in a little bit of money into buying 6 investment properties for cash. So that works very, very well for me, and I'm doing that same play again right now. But that's for me. I know how to get in, I know how to get out, and I've got that experience to do so. So don't take this as financial advice, but I hope you enjoyed this video on gold and silver. It's not me saying that silver's going up, that's Citi. Citi saying that, Jim Rickards, as we saw, Jim Rogers and the like. So there we have it, guys. Thanks for joining me today on this episode of Finance Uncut, and I'll see you on the next episode. See ya.